Banker acceptance are a type of payment guarantee by a bank, providing assurance of payment for exporters and reducing the risk of non-payment in the international trade. They can be traded as investment at a discount price in the secondary money market, similar to treasury bill. Bankers acceptance are commonly used by importing and exporting business and are considered relatively safe investment because the bank and the accepting party are obligated to pay the holder on maturity. Banks and international investors trade bankers' acceptance on the secondary market similar to the trading of zero coupon bonds. The market for bankers' acceptance involve importer, exporter, banks, international investor and local investor. They are commonly used in international trade to provide assurance of payment and reduce the risk of non-payment, especially when there is not a strong relationship between the buyer and the seller.
There are several reasons behind the banker's acceptance. Firstly, it used to facilitate the international trade. However, the importer and exporter are often face challenges related to payment and trust. To mitigate these concerns, the importer's bank issues a banker's acceptance to relieve these worries. Banker's acceptance usually has a short maturity period that can be used to facilitate safe and speedy transaction. It is clear that the usage of banker's acceptance in import and export offers an organized and safe method. Next, banker's acceptance is used to serve low credit risk in international trade transactions. The importer is responsible for the payment and this is supported by the bank and the value of the good being imported. However, with the availability of alternative financing options, the secondary market for bankers' acceptance has significantly decreased. Therefore, bankers' acceptance is seen as safe investments. Lastly, bankers' acceptance used to provide an opportunity for discounting due to their negotiable nature that they offer in the secondary market transactions. When bankers' acceptance is negotiable, the holder can assign the payment obligation to another party in creating discounting. Discounting bankers' acceptance can be a tempting choice for holders who are short on cash or who need money right away. Investors and financial institutions can purchase and sell bankers' acceptance on the secondary market.
Next, we go to the characteristics that the banker acceptance have. Firstly, short-term maturity. Bankers' acceptance are short-term financial instruments promising future payment within 30 to 180 days. The application process resembles that of a short-term loan involving credit and collateral checks. The short-term maturity benefit business in time-sensitive trade transaction, providing a flexible financial tool for optimizing position in a brief time frame. Number 2 is credit worthiness in trade facilitation. Bankers' acceptance are issued based on the credit worthiness of parties, with banks earning commission for facilitating trades. The bank profit is tied to successful contract execution, and these instruments are typically available to customers with a good credit history, often corporate entities. Number 3 is marketable short-term debt product. This is marketable short-term debt product that can be sold. In this situation, the one as of repaying the loan was entirely transferred to a third party. Such transfers are possible only due to the entity etiquette practice and strict credit assessment rules. Number 4, the lastly is easy of conversion and higher liquidity. It emphasizes the instrument reputation for easily transforming into actual cash and its increased liquidity due to swift funds transfer during creation. This combined with negotiable and simplify the conversion into cash, making banker acceptance a preferred choice in financial market that prioritize quick and secure transaction with a lower risk.
Bankers' acceptance (BA) is a short-term debt instrument that is issued by a bank and get guaranteed by the bank's creditworthiness. Bankers' acceptance also is a usance bill of exchange, as known as BA draft, and it can be accepted by the bank payable at a specific date in the future. However, it is also considered a secure form and most popular form of cash equivalence. Firstly is short-term maturity. Bankers' acceptances commonly comes with a short-term maturity. It is often ranging from a few weeks to several months. This will be a good choice for investors to choose because it is preserve capital and generate return over a relatively short time horizon. However, this refers to the length of time between the issuance date of the bank acceptance and the date when the bank is required to fulfill the amount of the draft, as known as maturity date. In addition, bank acceptance are observed to be short-term debt that have maturities of less than 1 year. Firstly is short-term maturity. Bankers' acceptances commonly comes with a short-term maturity. It is often ranging from a few weeks to several months. This will be a good choice for investors to choose because it is preserve capital and generate return over a relatively short time horizon. However, this refers to the length of time between the issuance date of the bank acceptance and the date when the bank is required to fulfill the amount of the draft, as known as maturity date. In addition, bank acceptance are observed to be short-term debt that have maturities of less than 1 year. Second is liquidity. Bankers' acceptance generally is highly liquid, which means that they allowing for effortless buying and selling in the market. This will make them an appealing option for investors that seeking a quick access to their money during emergencies. Bankers' acceptances can be traded in the open market. Next, bankers' acceptance are regarded as highly liquid because they are actively traded in the money market. This may be such a key of consideration for a bank backstopping a banker's acceptance. Thirdly is credit risk. Bankers' acceptance got issued by banks, which is commonly perceived as possessing to be high level of creditworthy. Bankers' acceptances might be perceived to be a low-risk investment. Thus, credit risk involves the possibility that the issuer of a financial instrument. Lastly is low-risk investment. Bankers' acceptance are considered as low-risk investments. It is because of their value got supported by the creditworthiness of the bank. As a result, the chances of default are lower to be compared. Last but not least, this can make them a really good choice for investors that wants to be assured of getting their money back.
The tenure of the banker's acceptance. The tenure of a banker's acceptance (BA) is typically short-term and varies based on the agreement between the parties involved. BAs are financial tools originating from international trade, functioning as a type of time draft. In simpler terms, it's like a written order telling a buyer's bank to pay a seller a specific amount on a set date. Next, the maturity or tenure of a BA is the time between issuing it and the due date for payment. Common tenures are usually 30, 60, 90 or 180 days, but they can be adjusted based on the needs and agreement of the parties. BAs often serve as a way for sellers to get paid and buyers to secure goods in international trade.